Welcome, fin crime leaders and compliance teams, to this explainer. If you're in the trenches of financial compliance, you know we're looking at a pretty monumental shift in the regulatory landscape today. Pakistan's removal from the EU high-risk third country list. Now, on the surface, this might just look like a standard bureaucratic change in country classification. But what it actually means for your daily operations, your transaction review queues, and your overall institutional risk appetite is absolutely profound. We really need to replace those blanket constrictions with evidence-based controls. And today, we're going to map exactly how to do that.
We've got a packed agenda for you. We'll unpack the delisting milestone itself, clear up some major list confusion that happens all the time in our industry, expose the remaining threats, and finally, build a highly practical 5-layer control stack. Let's dive right in.
All right, Section 1, the delisting milestone. This timeline really illustrates a rigorous and, frankly, exhausting regulatory journey for Pakistan's financial sector. It certainly was not an overnight fix. When we look back to June 2018, Pakistan was placed on the FATF gray list for increased monitoring, which meant an incredibly heavy focus on counter-terrorist financing. I mean, think about the sheer effort it takes for a nation to overhaul its entire financial regulatory apparatus. It's massive. They had to adopt a second action plan in 2021 just to address broader technical weaknesses that were still hanging around. But after successfully navigating those massive legislative and operational hurdles, Pakistan earned its FATF delisting in October 2022. And that momentum? It ultimately culminated in the March 2023 removal from the European Union's list of high-risk third countries. It's an incredible trajectory of reform that took a serious, whole-of-government approach.
Okay, moving right along to Section 2, FATF versus EU lists.
Let's clear up a massive point of confusion in compliance departments worldwide. Your teams absolutely cannot treat FATF and EU lists as interchangeable, right? They are related, for sure, but they have fundamentally different legal functions. The FATF gray list is all about increased monitoring. It emphasizes a risk-based approach and actually cautions against indiscriminate de-risking. But the EU list? Well, that one has teeth in a totally different way. It creates a mandatory automatic legal trigger. When a country lands on that EU list, regulated entities are forced by law to apply enhanced customer due diligence. We're talking about mandatory friction in correspondent banking, payment processing, and trade finance. So an EU delisting, ending that automatic legal requirement, that is a huge deal for how you process transactions.
To really grasp how we should use these lists going forward, I want you to embrace what I like to call the check engine light approach. Think of regulatory country lists like a dashboard check engine light for your compliance program. They signal a very real need to look under the hood and investigate further, sure, but they shouldn't instantly act as automatic stop signs that just stall the engine of legitimate commerce. A transparent, well-regulated customer shouldn't automatically face disproportionate restrictions or get their accounts frozen just because of historical country concerns. Basically, the light tells you to check the oil, not abandon the car completely.
Section 3, Performs and Remaining Risks.
34, that is the magic number here. Pakistan completed 2 massive, comprehensive action plans encompassing exactly 34 specific reform items. We are talking about a systemic, root and branch overhaul spanning across legislation, deep supervisory developments, and aggressive enforcement against illegal money and value transfer services. For example, they severely strengthened requirements for financial institutions to target unlicensed cross-border cash movements. They completely revamped how border agents and banks track currency couriers. This wasn't just checking a box on paper. It required real, gritty operational shifts on the ground to hit that target of 34 completed items.
And the payoff was huge. By February 2022, the Asia/Pacific Group actually assessed Pakistan as compliant or largely compliant with 38 of the 40 FATF recommendations. This technical compliance is an incredible achievement. It definitively proves that Pakistan's laws, regulations, and institutional arrangements now actively reflect global FATF standards.
But, here is the multi-million-dollar question for every single compliance officer watching this explainer right now. Does delisting mean zero risk? Does it mean every public body, financial institution, or transaction connected to Pakistan is suddenly totally low risk?
The emphatic answer is no, absolutely not. According to Pakistan's 2023 National Risk Assessment, severe structural risks remain highly material.
We're still seeing major threats from corruption and bribery, tax crime, and smuggling. And because Pakistan literally sits right across major global trade and migration corridors, things like unlicensed hawala and hundi networks, trade-based money laundering, and terrorist financing, they're still very persistent threats. Technical compliance and updated laws do not instantly prove that complex, deeply entrenched criminal networks have just vanished into thin air. Those networks adapt, which means your vigilance has to adapt right alongside them.
This is especially true for terrorist financing. Listen, terrorist financing controls absolutely cannot be static once an action plan is completed. Geography alone is an incredibly weak indicator here. The funds involved might be tiny, originating from perfectly lawful income before being quietly diverted. Risk hides in plain sight, guys. It hides in seemingly innocent donations, informal peer-to-peer transfers, front organizations, and nonprofit structures. This requires your compliance teams to actively use multilingual name screening and deeply contextual transaction monitoring to spot these complex diversion tactics. You need to identify aliases, indirect control, and shadow networks. You can't just run a basic matching algorithm against a historic list of sanctioned entities and call it a day.
Let's jump to Section 4, the Recalibration Challenge.
Because lists provide a really simple decision rule, it's super easy to fall into one of two extreme errors. The first is blanket de-risking, right? That's refusing customers or sectors without even assessing actual exposure. This actually increases financial crime by pushing legitimate trade into opaque, totally unmonitored channels. Now, the opposite error is automatic normalization, just assuming a delisting completely eliminates the need for enhanced scrutiny. This fatally ignores the customer and transaction-level threats we were just talking about. We absolutely have to avoid both of these extremes. The goal isn't some binary switch of all on or all off. It's about finding the sweet spot of differentiated assessment based on actual observable evidence.
So, Section 5, Building Resilient Controls. If your teams are tired of clearing endless false positives while you're still lying awake at night worrying about missing the true risks, I want to give you a highly actionable, step-by-step blueprint. This 5-step approach replaces blind trust and blind exclusion with evidence-led scrutiny.
Let's actually peel this control stack back layer by layer, because this is where the real operational work happens. First up, governance. Do not, I repeat, do not collapse FATF, EU, and national lists into one generic data field. You need to record the precise legal sources and effective dates. If a regulator knocks on your door for an audit, you've got to be able to prove exactly which list drove a specific transaction freeze on a specific date. Second, transparency. You've got to dig in to understand who ultimately owns the relationship and how their wealth was generated. Say a corporate client has a crazy complex holding structure stretching across 3 jurisdictions before reaching a beneficiary. Well, you need to unpeel those layers until you find the true human owner. Third, monitoring. Generic country alerts are practically useless. They just create noise. You need sector-specific alerts. In trade finance, that means watching for anomalous shipping routes or pricing that doesn't match global commodity averages. For real estate, it's watching for all cash purchases from offshore entities. Fourth, networks. Individual account reviews miss the big picture entirely. You need to analyze shared directors, devices, and telephone numbers. I've personally seen complex shell company networks completely unravel simply because a Shard compliance pro noticed 5 supposedly unrelated businesses were all logging in from the exact same IP address and sharing the same registered phone number. And finally, Layer 5, outcomes. You must constantly test if your country risk rules are generating actual suspicious transaction reports, or if they're just flooding your analysts' queues with false positives. If a rule triggers 1,000 times but leads to 0 escalations, that is a bad rule. Implementing these 5 specific layers ensures your AML program actively catches bad actors without unnecessarily punishing legitimate commerce. I really want us to internalize the central thesis today. Listing should not produce automatic exclusion, and delisting should not produce automatic trust. Country lists are merely regulatory signals. They're starting points, not substitutes for rigorous localized analysis. Pakistan's progress is real, it's technically sound, and it's highly commendable, but the risk environment in that region remains incredibly complex. I'm going to leave you with this provocative thought to take back to your teams today. Seriously, look at your own internal systems. Are your compliance controls merely reacting to a legal list, or are they actively engineered to uncover the true risks hiding beneath the country label? It is time for a disciplined recalibration. Thank you so much for joining me for this explainer, and I hope this sparks a deeper, much more evidence-based evolution in your own risk management strategies. See you next time.